Yep.
So my guest today is Scott Ely with Fairway Independent Mortgage. And Scott Ely happens to be my husband. So I'm going to ask him some questions, some probing questions, like I always do, right? So, hey.
Hey.
Okay. I think an important question for you would be name a couple of things that people shouldn't do or should do while they're in the process of getting a loan.
Well, honestly, this happens to me all the time. You'll get people that don't really think about the fact that they're spending money and doing things that they shouldn't be doing. When you take out a mortgage, you need to wait until after you close to go out and buy, let's say, new furniture for your new living room. They get excited about it, so they hurry and they go out and they charge that on their credit card, which affects, or even open a new credit card, which affects their credit and therefore potentially won't allow them to get the loan.
It also affects their debt to income ratio, right?
Correct? Because they're adding more debt.
Okay.
It,
So,
it also could affect their credit score itself because the credit card now has $10,000 balance on it instead of three. So,
okay. So, is it a good idea to pay off your credit cards while you're in the process?
no. Talk to your lender about that first. Sometimes we do need to pay down the credit cards or pay them off to be able to get the debt to income ratio in a position where they can buy. But don't do anything until you talk to your lender. That's very important.
Okay, so let's say I got my pre-approval, we're going through the process, and I'm thinking, well, nobody's going to know if I take out a new line of credit.
Oh, they will know because we
Why?
have to do we have to do a check right before we go ahead and issue the loan. So the day before you close, we basically have to take a look and see if there's any new credit that's been opened. And if it has, then we have to take that into consideration, which therefore could drive your credit score up to or actually lower your credit score and hurt you from being able to get that loan.
Okay, so, all right, so we've covered that. What about switching jobs in the process?
Not a good idea. It can be done, but we need to know about it up front so we can make sure that the new income and the new job start date would fit in with the ability to give that client credit. So it's not a good idea, but if you have to, then we can sometimes, most of the time, work around that. But do not go out and buy a new boat. Do not go out and buy new furniture. Like I said, don't go out and buy a new car. Those are the types of things that will really put a halt on you being able to buy that home. Okay. Buy the home first.
Okay, so because the interest rates are where they are now, what are they just under 8? Are they hovering around 8?
We're closer to the sevens, low sevens now, even into the sixes in some cases. It just depends.
Okay.
But people are hesitant to buy, which is a big mistake. Because honestly, if you buy a house today, instead of waiting a year till the interest rates come down, then that same house could be $20,000 more than it is this year. So we always say marry the house and date the rate, because once you're in the house and you're all settled, 6 months from now, a year from now, whenever those rates go down, we can refinance you into that lower rate. So get in the house, you get the advantage of the interest that you can write off on your taxes.
Right.
You're in the home, and then you know that you're going to be able to lower that rate. So that it's only going to be a period of time where you're going to make higher payments.
And you're going to have ownership in an investment for your future.
That's correct.
Instead of, renting.
People do that all the time. They hesitate, and they don't pull the trigger on buying that house because they think, oh my God, the interest rates are so high, my payment's so high. They don't think about tomorrow, and they really should, because that's critical.
So let's talk about, so we've been married 44 years, and
What?
yeah.
Wow.
And our first purchase was a townhome in Nashua, New Hampshire, of all places. And our interest rate at the time was
16%.
16%.
But we did get to refi about a year later at 10%, and we thought we hit the lottery.
Right.
Remember that?
Absolutely.
Yeah, so they're not bad. I mean, we really are headed in the right direction, I think, on interest rates. So But don't wait, don't hesitate, because the value of the house is going to be higher, like I said, a year from now than it is today. So it's going to be a wash. You get in the house, you're happy, we refinance for you. When it comes time, when the rates are lower, and it works out great for you.
And don't forget, you can write off all of the interest of your loan, which is 90% of your payments for the first couple of years. So that's huge tax savings for you. So we are a testament to that you can live through high interest rates. We're still going. We're still here.
And we have a bar sign.
And we have a bar sign. And we're outside, and it's not warm out here right now. But yeah, everything is relative, if you know what I mean. So we thought we hit the lottery at 10%, and those people that got in on the 2.75, 3.25, I don't think we'll ever see that again. Do you?
Probably not in the near future. But if we can get around
not in our lifetime, probably.
No, if we can get around the 5.5 mark, that'll be fantastic. Which
Yeah.
I think they're headed that way.
Yeah. So if you have any mortgage questions,
Please call me.
call this guy.
I'd be glad to help in any way I can.
We have 4 daughters, and we've helped all of them get into a home and at the right time in their lives, and they're all very glad that we did that, on top of all the people that we've helped in real estate and mortgage lending. So anyway, that's my bar talk for today. Bye, Scott.
Bye, Chris.
I'll see you in the kitchen.
Okay.
Okay, bye.
Do I have to grill?
Yes.
Oh, God, it's cold out too.
Bar talk is over.
Okay. Bye, guys.
Bye.